Hi there, everyone, and welcome from wherever you may be in the world. My name is Gordy Bannister, and I'm coming to you from sunny Southern California. And I'm happy to lead this very timely discussion that can help us as directors serving on comp committees create clarity in our incentive strategies during these very, very uncertain times. Just for your information, I don't know about all of you, but this is my first webinar in a long time, so you'll need to bear with me and us if there's some time delays on technology, that sort of thing. Like many of you, I painfully became an expert on the various video platforms, so forgive us if we have any hiccups on this audio today. But today I'm joined by Joe McNeil and Brett Herond of Pearl Meyer. They're going to share some best practices related to STI and LTI plan design in this volatile environment. We will also discuss how this particular business climate comes with unique considerations relative to stockholder engagement, public disclosure, and governance. They will highlight the emerging trends as we look ahead to the 2023 pay planning cycle, and also outline some ways that comp committees might work in a few new ideas that could help alleviate difficulties with goal setting this year. And of course, as we all know, goal setting is sort of the foundational aspect of actually getting compensation right. However, before we begin, I want to turn it over to Sarah King of the NACD education team because she has a few housekeeping items to share, and then Joe's going to kick off our program.
Thank you very much, Gordy. We have a few administrative announcements before we get started. First, I'll talk about the tools you have available in your webinar console. On the left-hand side of your console, you can see all of today's panelists and access their bios. In the top right corner of your webinar console, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. And in the bottom right corner, you can download a copy of today's slide deck and access additional resources. Today's slide deck is also available on pearlmeyer.com at the URL on your screen. As always, a recording of this webinar will be available early next week at both nacdonline.org/webinars and pearlmeyer.com. Your participation in today's live webinar earns you credit toward maintaining your NACD credential. NACD fellows and certified directors will automatically receive 1 credit for their participation. Please note that you must attend this webinar for at least 50 minutes in order to receive credit. Finally, we have a few evaluation questions at the very end of the program, and we would appreciate your feedback. So please stick around at the end of the webcast to answer those questions. And now I'd like to turn it over to our next presenter, who will present to get us started.
Great, thanks, Sarah. This is Joe McNeil from Pearl Meyer. I'm going to quickly run through our agenda for today. The main portion of today's talk will be focused on design and how companies over the last couple of years have rethought incentive plans in response to the volatility and the uncertainty that we've seen more broadly in the marketplace. Interestingly, in a lot of these cases, strategies that have been utilized in the past, in instances where there's been significant uncertainty, are resurfacing. But I think we'd all acknowledge that the impact of so many of the unique forces that we've seen over the last couple of years, including the pandemic, the geopolitical uncertainty, as well as just the broader macroeconomic environment, it really forced companies into more extreme responses. And what remains to be seen, although what Brett and I will be teasing out a little bit today, is the extent to which some of these changes will be more lasting in nature, given some of the uncertainty that we expect to see going forward. In addition to plan design, which will make up the bulk of the discussion, we're also going to touch on some of the other important elements that directors and board members more generally need to be mindful of going into the pay planning cycle that for a lot of calendar year, fiscal year companies is just going to start to kick off. Specifically, the evolving role of corporate governance and how this impacts pay, particularly among executive leaders. The shifts that we've seen with respect to disclosure requirements, in addition to to stockholder engagement, increasingly being front and center, and big influencers on both the magnitude as well as the structure of pay. We'll be touching on, and then finally, we'll lay out some early indicators going into 2023, pay trends that we expect to emerge, and one of the things as we move towards the end of the session that we'll do is we'll be gathering some input from the group around general sentiment, and perhaps even getting a little sneak peek among the participants today as to what we anticipate seeing and how boards will be approaching pay going into 2023. Where have we been? We've crammed a lot into the last few years, but if I start even further back, upwards of a decade and a half, have seen just monumental change in the executive pay corporate governance world. And it dates all the way back to the Great Recession and some of the big trends that emerged coming out of the Great Recession, specifically Dodd-Frank, and how disclosure and greater visibility and scrutiny around executive pay have influenced many of the spillover aspects of how companies think about establishing incentive plans, measuring both individual and corporate performance, and ultimately how these tie back to creating shareholder value. What we've flagged here in the middle, which is likely a familiar topic for most on the call, is the influence of proxy advisors. Really what had not previously been a big topic of, or a big angle that's considered by boards of directors, but now you can't escape a board meeting without discussing where prominent advisory firms such as ISS and Glass Lewis are going to weigh in on certain elements of an executive pay program or a broader corporate governance strategy for that matter. And I think what ties in directly to that is the rise of specific plan designs that conform to both the proxy advisory community as well as the bigger institutional investors that influence the proxy advisory community. And where that shows up most prominently, and we'll get into some specific examples around this, is relative TSR and the influence of stock price metrics when it comes to executive pay. And then, what increasingly becomes a uniform approach that many companies have adopted, again, keying off of, trends seen in peer groups and broader indexes, which has led to quite a bit of homogeneity when it comes to the structure of programs for senior level executives at publicly traded companies. Then we had COVID. And so without getting into all of the chaos of that time period and what continues to be the uncertainty associated with the next variant or other, potential sources of the next pandemic, the increased use of discretion and boards looking at all of the circumstances surrounding what companies are facing with respect to supply chains and other factors that are typically viewed as outside of the control of management, and how we want to explore potential modifications in our pay programs as a way to address that. What's been interesting is the overlay of these discussions around what is and isn't within management's control with what continues to be a very, very tight labor market, strong demand for seasoned executive talent to navigate companies through these turbulent times. So even companies that have struggled during all of the various factors that have emerged over the last couple of years, continuing to want to ensure that we've got meaningful incentives and retention in place for the leaders of the company. So finally, as we get into 22, and I'm going to turn it over to Brett here in a second, the extent to which some of these COVID trends will continue to carry through, or are we starting to hit more of a return to normal, I'm using that word in air quotes, as a way to think through what may or may not make sense going into our 2023 pay cycle. I'm going to now kick it over to Brett to walk us through section one of the presentation.
Brett Herron here with Perlmeyer, coming to you live from beautiful and noisy Chicago. It's Air and Water Show weekend, and we may get a blue angel or two buzzing the office tower during our discussion here. As we think about where we are now, trying to forecast the state of the economy over the next 6 to 18 months is about as challenging as it may get. If you consider some of the factors on the left-hand side of this page, you'd likely conclude that any slowdown will be short, mild, perhaps sector-specific, relative to what we kind of saw back in the 2008-2009 recession. If the next 12 to 18 months kind of manifest in this way, many companies can probably to an extent rely on the same incentive comp strategy, the same goal calibration methodologies that they used in the pre-COVID environment. However, when you consider some of the challenges in the broader economic environment they were laying out there on the right-hand side of the page, it may lead some to believe that the economy may be in for some more serious pain. I assume many of you saw what Jamie Dimon, the CEO of JP Morgan, said earlier this week about the chances of something worse than a recession. Obviously, that creates a lot of challenges as we think about incentive comp strategy and executive pay plan design. What this suggests is that not is all well, and compensation committees must be prepared to act to address some of this uncertainty. I'm going to kick it over to Gordy for our first poll question.
Yeah, thanks, guys. Thanks, Brett. So the first poll question has to do with where do you think the economy is going to be over the next 6 to 18 months? Are you confident, and how confident are you? So as we unwind all these COVID-induced trends, or that's happening, and then there's a possibility of a recession, not sure when, the real question is how confident are you? And one of the reasons this is, and you can go ahead and answer the question now in the poll, whether you're very confident, somewhat, neither way, pessimistic, very pessimistic. One of the reasons this is important because obviously as we try to establish compensation, how stable you think the environment's going to be in the upcoming pay periods has a role to play in what we try to establish. So that's why I think this is a good question for us to be asking.
And there you see the results of the poll. Gordy, your interpretation of this?
Well, actually, I'm surprised that we don't have more people who are pessimistic. I tend to be a glass half empty guy, so I'm actually a little bit more pessimistic than I think the overall group is here. But I think it's a little bit encouraging that we sort of have a mixture here between confident people sort of sitting in the middle and those who are pessimistic. I guess suffice to say, I don't think. Well, I don't know. I don't have a crystal ball, but hopefully what we see in the next 24 months won't be any worse than what we saw in the last 24. So I don't know. I guess that remains to be seen. But I would have thought there would have been more people who were just a little bit more pessimistic. But we must have more optimists on the call today.
I'll take that. Great. So as I've kind of alluded to, as companies consider the current state of affairs and how that relates to 2023 goal setting, companies should be kind of stress testing those executive incentive plans. The risk from misaligned incentive strategies can be painful. Performance goals become irrelevant. Pay and performance becomes misaligned. You potentially end up significantly underpaying executives, risking retention, potentially overpay executives, risking negative say on pay vote outcomes, risking unfavorable director elections, reputational challenges, obviously some governance issues. So So it's important for companies to kind of get ahead of this right now, get ahead of this kind of uncertainty that may exist. This is all kind of occurring against a background of ongoing discussion around ESG. And I think a lot of people are tired of hearing about it, and we're suffering from some ESG overload. But I think that may also be part of the discussion. As we will look at in the next few pages, there are lots of strategies worth considering, and we will talk about some of the next few pages, as well as kind of walk through a case study. So on this page 10 here, we're showing two examples as to how companies can kind of play with payout curves, both short-term and long-term incentives. The chart on the left shows a model where we have where we can relatively symmetrically adjust the payout curve on both the upside and the downside. This type of strategy, we often see companies employ, and it makes a lot of sense when you look at potential upside and downside variance in results, and there's a sense that that potential upside and downside variance is proportional. Also makes sense when you have a target goal calibration that results in a roughly 50-50 shot of achieving target. This kind of model is often one of the first things that we start looking at when we think about potential business uncertainty, is what the right shape of that payout curve may look like. The model on the right can be explored in two particular situations. One where either the unexpected or expected variance in results is not uniform. And if you think back to the results from our poll question, it seemed like that there was some, we slightly skewed toward more pessimism, which would suggest that, hey, maybe we should have a little more downside, in that payout curve. And so the expected variance in results is not necessarily uniform. We might also see this model where companies would typically engage in stretch goal calibration, and you have less than a 50% probability of kind of making your target goal. So that's the other model. That's the other reason why you might explore the model on the right.
Okay, so Brett, quick question. Gordy here.
Yeah,
so
Gordy.
when you do sort of a hindcast, if you will, of companies that had these flexible models over the last sort of 24 months, the last couple of years, tell us a little bit about what you guys saw in terms of the effectiveness of these models.
Yeah, good question, Gordy. As we kind of went into 2021, less so into 2022, but going into 2021, companies didn't really know how the pandemic was really going to play out. And so I think, there were some that, thought that this was going to be, COVID was going to have a long-lasting impact. And, there were other camps that thought it was, we were with vaccines, with the, the way the pandemic was playing out, that, we were quickly going to return to, a normal operating environment. That we largely used kind of a symmetrical payout curve, but we flattened it out a bit just because we didn't really know how financial performance results were going to be impacted in 2021. I would say where we saw companies struggle with 2021. I think it was for the most part when companies were kind of operating outside the bounds of kind of the core pay arrangements. I think the companies that kind of, stuck to an enduring comp strategy and maybe played with the payout curves, generally had an easier time, explaining the strategy in the proxy, avoided some of the say on pay challenges that we saw into early 2022. So I think companies that kind of focused on some of the enduring comp strategies generally did fairly well, working within this model. A good question.
Great, thank you.
So this next concept outlined here on page 11 is what we might refer to as a build-as-you-go LTI framework that can be used for financial performance metric performance share plans. Now, most of the meaningful shareholder constituencies, the institutional investors, expect a meaningful portion of LTI to kind of be delivered in a 3-year performance-based equity plan. And even in the calmest of times, right, some companies struggle to set multi-year performance goals. Well, under a build-as-you-go LTI strategy, you can kind of get away from setting those 3-year performance goals. And instead of kind of setting those up front, we're going to set a series of 1-year goals at the beginning of each year in the 3-year cycle. And then you don't end up settling the number of shares earned until the end of the 3rd year. There are some challenges, right, that we have to acknowledge in this kind of a model. It's not a true 3-year plan. You potentially run into some funny numbers in the proxy statement if you do, transition back to a more conventional 3-year plan. If this is the temporary solution to uncertainty, and you want to transition back to a 3-year plan, there are some disclosure challenges that you should just be aware of. We've also seen companies under this kind of a model put what I might call a catch-up provision in place. So you may not, earn into, a particular year within this 3-year model, but companies have put in these catch-up provisions that say, if we do this over the full 3-year period, you're going to have an opportunity to re-earn what you lost in one of the earlier years. We've generally seen the proxy advisors view that as view that unfavorably. And so when we've gone to this kind of build-as-you-go LTI strategy, that's always part of the discussion, this catch-up provision. But I think, we've generally concluded that is a losing strategy with proxy advisors and with institutional investors. So here's just a quick case study I can walk through that may be familiar to 1 or 2 of you on the call. But a publicly traded client with a new but experienced management team dealing with a drop in stock price driven by some reductions in profitability. There was an existing LTI strategy in place, but there wasn't a whole lot of support for it either by the management team or by the compensation committee. So when Pearl Meyer started working with this client and we tried to determine kind of the best go-forward strategy, we ended up putting kind of what I might call a stopgap strategy in place where we dropped a 3-year TSR plan and just went to a simple 1-year PSU with a payout deferral to buy us some time really to think about what the right LTI strategy was. Glass Lewis, as one of the proxy advisors, did not like this and did issue 2 no-vote recommendations. But in both years, there was a successful say-on-pay outcome in the 80% range. So as we kind of thought long-term about the right solution to LTI strategy here, we ended up kind of going to a mix of options, RSUs and PSUs. PSUs were, we were delivering 50% of the overall LTI opportunity in performance-based equity, which generally makes the proxy advisors happy. We did a 1-year kind of build-as-you-go set of 1-year goals using earnings per share. And then what we did to address, proxy advisor concerns around 3-year goals, around relative metrics, we put a 3-year relative TSR kind of modifier around the full kind of 3-year cycle. And we sold all this with some very thoughtful disclosure in the proxy statement and some good shareholder engagement. And under this model, we did get proxy advisor support. We did have several years of successful say on pay vote outcomes. We just recently returned to, once strategy was in place, once the turnaround was well on its way, we went back to a more conventional 3-year PSU plan, but did in fact retain the RTSR modifier. So this kind of a model has a lot of precedent out there, but again, there are things that you can do to ensure that you can get support from key constituencies with say on pay votes.
So Brett, just to click back on this icon just a little bit, talk about the effect sort of beyond the C-suite of making this change. Most plans like this have, I don't know, pick a number, 30, 40, 50. They have sort of the C-suite plus 2 involved. So talk about the implications on that bunch for making this change, and then say some more about how you see this as something that's maybe different to be utilized when a company's kind of under stress and really got a difficult situation versus what I would declare sort of in some circles people would call this normal volatility. Maybe it's not, maybe it's abnormal volatility, but just living in a volatile environment. I mean, I came out of the oil and gas industry, and so prices one year could be 100, another year they might be 25 or 30, and so we didn't kind of change all the plans every year based on having oil price fluctuations. So can you just talk a little bit about that?
Yeah, certainly. So in this particular client, the performance-based equity was actually just kind of limited to the top, top dozen or so executives. So it wasn't an issue below that senior executive level. But I think when you start talking about the experience of those kind of below the executive level, right, what you typically see is an LTI strategy that skews a little more toward time-based equity, just because there's not nearly as much line of sight to overall financial results, to stock prices as well. And so doing something like this, I think, I don't know if this is the right LTI model, right, below the executive level. Once you get down to kind of director and VP level, I certainly think, an LTI strategy that is more focused on, time-based equity, service-based equity, makes more sense with that population. Right. I think you want a high perceived value for your LTI arrangements, at that kind of level of employee. Your question, Gordy, on when you might see this, do you see this under kind of the normal ebbs and flows of the economy? Probably not, right? I think this type of a solution is one where you are dealing with company-specific business uncertainty, whether it's a turnaround, whether it's a meaningful change in business strategy, and trying to set multi-year goals becomes very challenging. Obviously, we're talking about this as a strategy right now, and it's not because it's a company-specific challenge, but an economic challenge and trying to forecast what the economic environment looks like over the next few years here. I don't think this is the right solution under the normal ebbs and flows. I think you want to have a more conventional arrangement that does create some line of sight for multi-year financial performance. Under a build-as-you-go LTI strategy, I think the idea of a RTSR modifier makes some sense. It does scratch the itch of the proxy advisors who are looking for relative performance. It does scratch the itch of the proxy advisors and multi-year LTI arrangements. But this is really about creating short-term line of sight to results because you don't have the long-term visibility to performance.
Got it. Thank you. Thank you.
Now, briefly talk about the role of ESG and incentives, as a way to control for or limit the impact on incentives of some of the exogenous events out there. So yes, we'll talk about ESG, but again, just for a few minutes. Current data shows that almost 60% of companies are including ESG somewhere within the incentive comp structure. You can see in the chart on the left that more than half the time that's showing up in short-term incentives and showing up in LTIPs in a small minority of cases. Just a quick sidebar on that where do we see ESG show up in long-term plans? It's a lot within energy industry. So that's that 6% down there on the bottom left. When you look at the E, when you look at the S, and when you look at the G metrics, social metrics significantly more common than either environmental metrics or governance metrics, favored by roughly 3 to 1. When you look in the S&P 500, I think the last stat I saw was 138 companies have a diversity and inclusion metric somewhere in their incentive plan. Again, most often showing up within short-term incentives, either as an individual performance factor, for a particular executive or particular executives or group of executives, a discretionary factor across a short-term incentive plan, or as kind of a scorecard metric. So I don't think anyone expects, again, ESG to go away, but this is another kind of tool that the committee has to ensure that we're creating a line of sight for management incentives. And that will bring us to our next poll question.
Yeah, so Gordy, back again. So I think, I guess my not so humble opinion is that ESG in some form or fashion is here to stay. So I think the question for everybody is, where are you on your ESG journey, and linking that to executive comp or incentive comp in your company? Have you talked about it at all on one end of the spectrum, or you do tie it in? I can tell you, I sit on the board of Dow, and this year we put a carbon metric in the LTI, actually. So we've had it in the STI. We've got it on the LTI going forward because, quite frankly, it's part of the company. It's part of who we are. I can also say, when I was over at Tyson on comp committee there, even though we're not an energy company, we had safety in people's performance appraisal. So I think, I guess I'm a firm believer that it's really important that these different things get included and incorporated into executive compensation, because if you don't measure it and you don't pay for it, people don't do it. So yeah, Brett, if we take a look at what the responses are, people are having discussions about how to attach it. I mean, what do you guys think about that? What do you and Joe, what's your takeaway from this?
Feel free to chime in, Joe, but this data, I guess, would track with my kind of on-the-ground experience. I think tracks reasonably well with the prevalence data that we just viewed on the prior page. we're up close to 50%, a 50-50 split.
Yeah, Brett, this is Joe. I guess I may have expected that these bottom two categories would have been maybe slightly north of 50%, so maybe a touch lower than expected. But again, I think that this is certainly reflective of the trajectory, right, that many companies are on with respect to ESG.
Right.
So real quick, guys, who do you think is in the space of having not discussed it at all? I mean, I have an opinion, but you guys are the experts.
I can take a stab, Brett, and then I'll have you maybe jump in. In my experience, companies that haven't even raised this as a consideration are generally speaking just earlier stage, right? Where in some cases we may not even have a formalized short-term or long-term incentive plan to speak of. So as a result, we haven't kind of gotten into this discussion yet. In my experience, it's when you kind of begin to formalize some of these plans and you're aware of some of the broader trends that it's at least become a discussion topic. Brett, I don't know if your experience has been any different.
Yeah, I think that's right. This chart would closely track, how formal do you administer your exec comp plans. There's probably pretty strong overlap with do you have ESG in your incentive plans. If you're a formal exec comp administrator, you're unlikely to have ESG formally showing up in your arrangements. All right, the last item that I'll talk about here, again, as a strategy to kind of mitigate some of this uncertainty, is potential adjustments to your equity incentive mix. By reducing the portion of LTI delivered in this goal-based equity and replacing it with time-based equity, you release some of the pressure on goal calibration. We saw a number of companies take kind of similar actions during the heights of COVID. Booking, Fox, Simon, Ultidis, we grabbed a couple of examples, noting that these strategies are not without risk when you see the failed say on pay vote there for Booking. Not entirely because of the mix change, but certainly I'm sure that was certainly weighing on the minds of the advisors and institutional investors when they were doing voting. There are some strategies to make this palatable to institutional investors, to ISS, to Glass Lewis. Not completely eliminating the performance-based equity, keep something in there, including a commitment to, reintroducing or including performance-based equity in the future, attaching some, different vesting or ownership requirements or holding requirements to, to a larger time-based equity award. Keeping a majority performance-based LTI strategy for the CEO. And finally, maybe using some soft goals on performance-based equity to make it look and feel like a time-based award to the participant. So again, those are some of the strategies that companies have considered when they've looked at potentially making adjustments to the equity mix, again, in response to some of this uncertainty. Now I'm going to pass over to Joe, let him talk about some of the external risk as you navigate this path forward.
Sure, thanks, Brett. So we'll now shift the discussion a bit here, talk about how potential changes in incentive plan design are communicated externally within the current framework, along with some important changes to the regulatory and disclosure requirements that we are anticipating going forward. An important dynamic to mention here is that while enhanced disclosure requirements are typically met with pushback from issuers, right? This is just another item that we've got to include in next year's proxy statement or 10K. We really have seen a meaningful shift in perspectives over the last 5 to 10 years as various elements of the Dodd-Frank Act have taken hold, where companies are now really viewing the proxy statement as a really valuable opportunity to communicate with stockholders and use this annual exercise to lay out the rationale for investors on, around the merits of our pay programs, as well as, the important circumstances that would influence the design of our incentive plans, as well as the magnitude of pay that we're delivering to senior leaders in the company. This table that you see down here at the bottom, I want to make an important point here that this is just an example, and it remains a work in progress at the SEC, although this pay for performance table that was originally a part of the Dodd-Frank Act all the way back in 2010, we are anticipating that this is going to be finalized later this year. Open question on whether or not it's going to be an obligation for companies to include in 2023 proxy statements or 2024, but certainly something that would have a meaningful impact on how companies think about incentive plan design if, this is the new standard when it comes to what we're going to have to disclose externally. And what the nuance here, right, is this question of the actual numbers that are disclosed in the summary compensation table, which we're all very familiar with in each year's annual proxy statement, and then this concept of realized pay among senior executives, and the fact that we're now having to, in a very clear way, show the linkage between actual pay outcomes for senior leaders and stock price performance in the form of total shareholder return that we would have to include, not just for, our own ticker, but also for a basket of companies or a peer group that we use for benchmarking purposes, right? So the question that this immediately triggers for folks like Brett and I on the advisory side is, the extent to which, these metrics that you see over here to the right, and obviously the most interesting one is this bracketed element at the far end, which is the company selected measure, how these new incentive goals may or may not be included into both the short-term and long-term incentive plans that companies are utilizing. In many cases, companies would look at, in particular, operating metrics like net income or whatever the company selected measure would be, and say, well, is this really, number one, something that we want to disclose in such an overt manner? And number two, is this something that's really, based on what we've heard from our key investors, something that's going to materially move the needle when it comes to overall company performance and how we evaluate management? So it really will be interesting to see, number one, where the SEC lands on kind of the final version of this table, and the extent to which, the tail may begin to wag the dog when it comes to what we've got to put in our proxy statement and how this may influence what shows up in our incentives plans going forward. Another interesting trend that we've actually already begun to see in 2022 that is notable and critical for those on the board, as well as just kind of broader governance community to be in the loop on. And it has to do with a specific element of kind of the annual process that companies typically undertake with respect to shareholder engagement. And, what's underpinning all of this is, what we've seen over the last few years as an enhanced level of expectations, particularly for companies where we've had a low say on pay vote, or we've had other shareholder-related votes that have come in below a certain threshold in terms of stockholder approval, where there's now an increased focus on how the board responds to these sorts of, very direct feedback opportunities that are coming from shareholders. Historically, the bar has been set relatively low, where the expectation is, the board, along with members of management, are going to, have ongoing dialogue with key investors and ensure that their perspectives are, being, carefully cataloged and considered when it comes to how we would set up our short-term and long-term incentive plans and how we would manage our pay programs more generally. What we saw in just within the last 6 or 8 months, so basically the 2022 proxy season, is increasingly, an expectation that companies go further. And by further, I mean not just, going on a periodic listening campaign, but taking the feedback that's been provided by our bigger institutional investors, as well as what we're, hearing more broadly across, our investor base, and putting these changes into the plan, right? And so historically, there's been more of an expectation around listening, but increasingly now we're seeing companies say, well, we've heard you loud and clear, but we're not necessarily ready to go all the way there, and here's why. So it'll be really interesting to see, again, coming back to this concept of what influences how we think about goal setting and selecting specific incentive plan measures, the extent to which feedback that we receive from our prominent stockholders will begin to influence that. Brett already kind of touched on the ESG concept, which I've mentioned down here at the bottom, but maybe more generally, what we saw a lot of in, call it the back half of 2020 and into 2021 are, companies allowing for, greater flexibility and more willingness to apply discretion and perhaps even make modification to in-flight incentive plans, given all the economic turmoil and some of the other uncertainty that would exist in the market. What's come through pretty clearly thus far in 2022, and the main indicator that we would cite is say-on-pay voting, where companies that have gone in and perhaps either once or even more than once made modifications to incentive programs or applied excessive discretion when it comes to determining actual pay outcomes for executives, really beginning to take a hit, whether it's on say-on-pay or director elections or other mechanisms that stockholders can use to make it clear that we're dissatisfied with the way things are being run, specifically around management being kind of held to task for company performance. So in addition to an increased reliance on ESG metrics, which I think does create an interesting vehicle for companies to say, we need to make this a higher priority. Could you argue that those metrics are often less susceptible to market volatility? I think most would say yes, but there's a separate consideration around predictability. If these are new metrics that the company hasn't historically tracked, do we run into challenges when it comes to forecasting out on a 2 or 3 year performance curve? So something to carefully consider. And then, the other one that continues to pop up with respect to Brett and I and kind of our broader client base is around relative performance, right? So rather than pinning down the team and having, what often ends up being quite a bit of back and forth when it comes to how we set appropriate performance threshold, target, and maximum levels. Instead, just identify, a reasonable basket of companies that we would compare to on a relative basis. And historically, that's been around stock price, but there's really no restriction on companies thinking about other return metrics, ROIC. We see ROI to a certain extent as well, where companies are saying, rather than try and forecast out, maybe we just simply, look at how our peers are doing and we pay executives out relative to that benchmark set. So other mechanisms that could be considered with respect to goal setting that help take some of the pressure and the stress out of that process. An interesting case study to throw out to the group here on the following slide. We spent the bulk of today's session talking about goal setting and the importance of performance metrics and performance goals and incentive plans. There is a counterpoint to be made, and this has been written about and talked about by many others. But just in a nutshell, the Sovereign Wealth Fund for Norway, which owns a not insignificant portion of all of cumulative global equity, takes the position that in a world as complex and uncertain as the one we're living in, what if instead of spending, what ends up being an enormous amount of time and resources in setting 2, 3, 5 year performance plans, what if we just shifted to more of an ownership framework? And, again, this is not, I would not want to characterize this as a standard practice in the US, but provocative nonetheless, where we would simply say, let's give senior leaders in the company a meaningful portion of stock, and rather than tying it to 1, 2, 3, 5-year performance, we simply install a holding requirement that says, regardless of whether you're still employed by the company, you've retired, you've moved on, whatever you've done, you're obligated to hold the stock for 5 or 10 years, right? So the idea here would be we're accomplishing the long-term orientation, but we're doing so in a way that doesn't necessarily require us to set and reset and modify goals in a way that really doesn't resonate with stockholders. So in this vein, we move to our third poll question here, which focuses on how directors are thinking about plan design going into next year. Gordy, I'm going to turn it over to you.
Yeah, so I think, thanks, Joe. I think the question at hand then is, so are you contemplating different approaches with your executive incentive plans sort of next year? Are you making changes to the STI, the LTI, both? Discussing changes but haven't made decisions yet, and so on. And I think, again, this is an important question because it's probably on the table for everybody. I think the real issue is, so how far are people going to go with this? And because at the end of the day, how we pay the executive teams has a lot to do with the outcome of the business, and it boils back to how are we going to actually help drive shareholder value through the incentive compensation plan. So let's see what people think. Let's see what the results of the poll are. Yeah. So a significant number of groups, people are having conversations, but they haven't made their decisions yet. I suppose that's a function of the timing of where we are in space right now. So that's actually a good thing.
Yeah, I was going to say, Gordy, that's kind of a nice segue into our final slide here, where, again, just based on where we're at in the year and some of the persistent questions around what things are going to look like by year's end, the vast majority of boards that we work with are taking this, quote, wait and see approach, where, certainly want to begin to lay the groundwork for potential changes to long-term incentive plans in particular, but less so, ready to kind of firmly put a stake in the ground on that. Interestingly, I think, going back to what I shared a few minutes ago, some of the questions around disclosure, as well as, what potentially could relative performance metrics in particular add to the incentive plan, I expect to be key discussion topics. And then finally, this question on ESG, which, Gordy, I agree with your remarks from a few minutes ago. It's here to stay. There is, however, what's beginning to be a bit of a groundswell around, wanting to ensure that ESG isn't used as a justification for companies to create significant disconnects between pay outcomes and actual company performance, against more conventional financial metrics. That's an important consideration here as well. And then, what I think will help in this discussion is what, another element that we expect to see from the SEC towards the end of this year is a more consistent framework for disclosure around ESG metrics and how they're tracked and how they're disclosed. So for that reason, just promoting reliability and uniformity in how various companies are, characterizing their reliance and emphasis on ESG should help mitigate some of the, some of the backlash or the countervailing views that we're beginning to see. I believe that was it in terms of content for us. I'm going to turn it back over to you, Gordy.
Yeah, thank you. And I think that, I guess the piece that I'd add is that there's this big political cloud and climate that has to do with ESG, and it's up to companies to kind of forget about that, not with respect to how you engage the government, but rather how you meet the needs of your constituents, the people inside the company, and your stakeholders and shareholders. And so when I think of safety and reliability, for example, in an energy company, it's much better for the shareholders if you don't have things go boom and you don't have things go bang. So paying people in conjunction with that makes great sense, right? It's not necessarily an HR metric, it's an operational metric. So I think we just have to make sure that we're satisfying the needs of our constituents, stakeholders, and shareholders. There are a couple of quick questions. Let me see if I can, I'll get to one or two here before we have to sign off. When there was questions, you were talking about sort of changing, well, is it possible for people to be talking about changing threshold targets? Have you seen and have you had experience with people changing threshold targets with respect to the comp plan? Just real quickly, yes or no, and how's that tracking?
This is Brett Herron again. I did have one client, a publicly traded client, adjust their target threshold and maximums for in-flight multi-year performance-based equity programs. What they did, I think, was there were no challenges with say on pay. We provided good disclosure. The committee engaged in a very rigorous process, in coming to that decision. But I think they were certainly, a minority case in ultimately arriving at that decision.
Okay, great. Thanks, Brett. And the NACD folks haven't jumped on yet. Let me just ask another quick one, just about discretion. So I know on boards that I've been on, we've exercised discretion. Talk a little bit about, if you could quickly, maybe 10, 15 seconds on boards using discretion when it comes to comp.
Why don't you take that, Joe?
I can jump in here. Yeah. So, Gordy, in my experience, discretion is a very, a very typical approach in the short-term plan, particularly when we have a balanced scorecard or some sort of other less quantifiable metric that, when it comes to deriving, actual pay outcomes for the annual incentive plan, it's an important component. Less so on long-term, right? I don't typically would involve something more along the lines of a modification or, other, accounting impacts that make it, number one, a lot more challenging, and number two, less palatable to stockholders. So yes to discretion, but typically focused on short-term cash incentive plans.
Okay, great. Thanks, team.